talking to everybody here. Have Ateet from CoVenture Crypto, and we're going to be talking a little bit about how institutional investors look at the crypto asset market as a whole, and talking a little bit about some of the quantitative strategies that Ateet leverages on a daily basis, and kind of how he looks at the market as a whole.
So let's see if we got this. I'm going to take over that. It's it's not actually plugging in.
It's a little bit more advanced than the typical webcam that we're used to, so we'll roll with it.
We good?
You might have to just talk.
Oh, okay. Oh, we got it. Okay, perfect. So a lot of times when you think of quantitative strategies, a lot of people will look at a chart and think of chart patterns, things of that nature, what looks good optically, and that should be a key to making money. What I've found in my history working at Goldman Sachs and Blue Crest and a couple other firms is that is almost 99% not the case. So what we like to do is take digital assets and then model them up like we would any other commodity, currency, equity, bond, what have you, and see if there is any statistical relevance to a particular trading pattern or trading idea or data source that we think might have an edge. And one of those, a lot of people will look at moving average crossover. So that was very big in commodities in the 70s and early 80s. Before that edge eroded, it was huge in equities in the late 80s. And a lot of people look at that as a mechanism to kind of gauge whether or not they should be buying or selling cryptocurrencies. And if you look at the chart here, just as a simple mock-up, it looks pretty good. When the 20-period moving average crosses over the 40, you get this entire gain here. You get to take advantage of the entire rise of cryptocurrency. And when it crosses back through, you probably want to harvest those gains and either go outright short or just make sure that you lock in some of your profits when we get sort of to that area. And while it looks good optically, when you actually run that strategy on Bitcoin, it actually has several different issues. So someone might look at it and say, oh, someone might say, hey, look, it's made $136,000 off a $10,000 base during the life of Bitcoin. But when you actually look at it, it's like, okay, well, it's only had 33 trades, right? So it's actually not that terrific. When you look at the graph, it looks reasonable. But when you strip out the 5 biggest wins here, you get an equity curve that's a little jumbled. It's much more like that. So you end up with something that's not exactly robust and not exactly repeatable. So it's important for people to take all those risk metrics into account and to take something from a visual cue into an actual system and actually see, well, what are the odds of this actually making money based on history? It's not really fun because you end up with things like this where you see that, oh, hey, it only wins 39% of the time. The Sharpe ratio is 0.1, which is actually astounding. I've never seen something with that low a Sharpe ratio. And despite making money in theory, when you strip out all the big winners, you actually, 5 of the big winners, you end up with something that's not profitable in any capacity whatsoever. So what we try to do is not only come up with strategies and systems, but make sure that they're appropriate given the risk metrics we look at. So there's about 13 different risk metrics we look at, as well as how they combine with an overall portfolio and change the risk of that basket as well.
And when you are looking at these types of metrics, I think a lot of people, when they think about crypto trading, it's kind of a retail-driven type of play for a lot of people.
Yeah.
How long does it take someone like yourself to come up with a lot of these metrics, a lot of this testing to actually determine what an appropriate quantitative strategy is? Because like you said, you don't just go into a trade and assume that it's going to work. You actually do that testing, kind of through the course of time to determine what will actually win on a consistent basis. How long does it take you to figure some of that out?
So this is, it'll take me if I have a strategy, it'll take me a good 2 to 3 weeks full time, so 14, 15 hours a day of peeling back the onion, making sure it works, making sure the metrics are appropriate, doing a lot of different scenario analysis, such as stripping out like the 5 biggest winners, for example, or seeing what percentage of the equity curve is dominated by the top 10% of trades. Things of that's one of 13 different metrics and tests that we'll run to ensure that there's actual robustness there, not a coincidence, not luck, not a handful of trades really winning. I think the difficulty in the cryptocurrency space is you've got 2017, which basically saw Bitcoin rise 13-fold, and you saw other digital assets rise even higher than that. So you have to actually do scenario analysis that's bucketed on time as well. So what happens if we strip out 2017? Does it actually work? Because the fact of the matter is you could have just thrown a dart at a board with every day listed in 2017, and as long as it was before November, you would have been, quite well off. So doing that analysis on a time basis, on a risk-adjusted basis, doing scenario testing, that'll take a good 3 weeks if it's just me on my own. If it's me with the rest of my team, I think we spoke with Nikhil a little bit earlier, it can take substantially less time, but nevertheless, it takes a good amount of time.
Absolutely. And as you kind of continue to move forward and kind of build out these strategies internally, is this, just as far as the industry goes as a whole, is this the type of thing that you feel like kind of across the board, the professional investors in this industry are doing? I think a lot of people just don't necessarily have that maybe level of depth of understanding as far as the industry goes, maybe more on the retail side. Is this the type of thing that other professional investors in the space kind of go through on a consistent basis as well?
Yeah, well, there's two things. I think the majority of funds in the space are more on the venture capital side. I think that as traditional Wall Street players get involved, this will be exactly the kind of analysis they do. But I don't think it's out of the reach for the average retail investor. You can buy certain platforms. This is done on Trade Navigator, for example. It doesn't require you to be a coder with a PhD to kind of test your ideas there as well. But this is definitely where the trading side of things is headed. If you look at what percentage of the market is done by high-frequency traders, it's already around 30% on any given day as a ballpark. So it's very important for people to realize that 2017 was more the exception rather than the rule. Things will start to evolve into a more durable trading environment as some of the more traditional investment firms get involved. And just a quick example of that is when you look at blockchain technology and patents that are being created. Coinbase was only number 6 in 2017. We actually had, Bank of America led the pack in terms of the amount of blockchain-specific patents that were being created. Different firms are looking to get involved from a custody perspective. So once you get the clarity around custody, once you get some more clarity around other things, people will start to head in, and it will be a much more professionally dominated market where people are looking at more robust systems to trade.
And maybe finishing off here too, looking at, I know we looked at the Bitcoin chart here. When you look at assets in the crypto space to potentially trade, I think liquidity is something that a lot of people look at and think about. For you, is Bitcoin kind of the main asset that you look at on a consistent basis because of the liquidity in comparison to the other crypto assets?
Yeah, so I'd say that that's a really good question. So the majority of the trading is done on, I'd say, the top 3 crypto assets, predominantly Bitcoin and Ethereum, because on any given day, they make up 60 to 75% of market dominance. Therefore, you have to trade where liquidity is. And you also have to look at, what's the true market cap? When you look at something like Bitcoin, at the end of 2017, there were 17 million mined. Chainalysis and a couple other firms came out and said that up to 5 million of those coins are now gone. So roughly a third, just under a third of the market cap is actually gone. So you have to think about, what's my realized traded market cap? Some of these other tokens, they don't have a lot of trading volume on a daily basis. So you're trapped from a liquidity, from a bid offer standpoint. And it's important to make sure that you have outs. So part of the analysis that we didn't show today revolves around liquidity, slippage, bid offer, things of that nature. Due to that, yes, we definitely stick to the most liquid crypto assets.
And I think at this point, we're going to be bringing over Rob Nance from CityBlock, as well as your partner at CoVenture, Nikhil, to talk a little bit about specifically how NYCQ is working in this space and is kind of leveraging some of the techniques you had talked about previously, as well as some of the other topics earlier as well. So, Rob.
Thanks, Bobby.